In the previous few sessions that we've had, we had talked about financial intermediaries. We learned what a financial intermediary is. We learned that a financial intermediary is nothing more than a mediator or some middleman who acts as a link between the savers and the borrowers of finance. And under the various financial intermediaries in the financial services sector, we saw three categories: banking institutions, non-banking institutions, and the investment institutions. And then we saw under banking institutions, we had the organized banking institutions and the unorganized banking institutions. Similarly, in case of non-banking financial institutions, we saw again the organized as well as the unorganized financial institutions. And after that, we moved ahead towards the investment institutions, wherein we talked about the Unit Trust of India, UTI. We also talked about the Life Insurance Corporation of India, LIC, and the General Insurance Corporation of India, GIC as well. And additionally, we also discussed a little about mutual funds, what is the meaning of mutual funds, and why people invest in mutual funds. So moving on for today, we are going to be discussing about a new financial intermediary. Let's deal today with the credit rating agencies. So before we talk about what credit rating agencies are, let us dig again into the topic of credit rating. We have already talked about credit rating, what it means, but let's just revise once again. Okay, let's just remind ourselves once again the meaning of the term credit rating. So credit rating is nothing more than the analysis of possible credit risks associated with granting a financial instrument to an individual or a company. So credit rating is nothing more than rating the credit worthiness of an individual or a company, okay, and checking whether or not the investing in those people, financing those particular groups or institutions will be risky or not. So rating is provided based upon the credit worthiness of the person of the company, as well as the credentials of the individual or the company. And the credit worthiness of an individual or a company will be decided based upon the lending and borrowing transactions that have been done in the past. So they are going to be able to determine the credit worthiness of an individual or of an institution based upon the past transactions that they've made with regards to the credit, okay, whether they pay their loans on time, whether they have had any kinds of overdraft facilities, all of those, okay. And then credit rating can be determined after weighing the statements of liabilities and assets and also their ability to meet the debt obligations, okay. So it's going to be based upon their assets and liabilities and also the ability of the individual or of the firm to meet their debt obligations. So the definition of credit rating. Credit rating is an analysis of the credit risk associated with a financial instrument or a financial entity. It is a rating given to a particular entity based on the credentials and the extent to which the financial statements of the entity are sound in terms of borrowing and lending that has been done in the past. So for credit rating, it depends upon the historical figures, and it also depends upon the goodwill or the credentials of a particular individual or of the firm that wants to study its credit worthiness or its credit situation. So when we're talking about credit rating agencies, what exactly is a credit rating agency? So a credit rating agency, also known as CRA, it evaluates and assesses an individual's or a company's credit worthiness. Okay, it studies the credit worthiness of a individual or of a company. So these agencies, they consider a debtor's income and credit lines in order to analyze the debtor's ability to repay the debt or to check if there is any credit risk associated with that particular individual or that particular company. So SEBI, Securities and Exchange Board of India, it reserves the right to authorize and regulate credit rating agencies according to SEBI Regulations 1999 of the SEBI Act 1992. So SEBI is the one who's capable of authorizing an organization or authorizing an agency to work as credit rating agencies. So how exactly do credit rating agencies work? So in order for a credit rating agency to function, credit rating agency will analyze an organization or an individual or an entity with and then they will assign ratings to it. So these agencies, as you've seen earlier, they should be authorized and regulated by SEBI, right? So these agencies have the authority to rate the companies, state governments, non-profit organizations, countries, securities, local government bodies, and even special purpose entities. They're not meant just for the companies that are listed. They're not just meant only for listed companies, but they're also meant for state governments, even non-profit organizations, and they can even rate countries, and they can even rate local government bodies, and other special purpose entities. Now, many factors are going to be considered with regards to rating of financial institutions, or with regards to rating of individuals. Okay, so these factors include financial statements, and then types of debt, and then lending, borrowing history of the individual or of the company, repayment capability of the person who's being rated at the moment, and then past credit repayment behavior, and so on. And each of these various factors will be contributing to a specified share in computing the end result, or the end credit score of the individual or of the company. Now, the credit rating agency does not provide any decision as such to financial institutions on whether an entity should get credit facility or not. Instead, they will just provide report and additional inputs to make it easier for the lender to analyze and to make an informed decision. Okay, they're not going to tell the financial institutions, yes, provide credit to that person, or no, don't provide credit to the person. Okay, rather they're just going to give you options. If you want to provide them credit, these are the reasons why you can or why you should not provide them with credit. They will not give you the clear-cut answer, but they're just means to an end. Okay, so these are your credit rating agencies. And finally, under financial institutions, you have your credit card issuer companies. So basically, from the term itself, the companies which issue credit cards are termed as your credit card issuer companies. Now, the moment we say credit card issuer companies, what comes to mind may be banks. Right? Banks, we feel, are the main authorities or are the main contributors towards credit cards or towards the issue of credit cards. So a credit card issuer can be a bank, or it can even be a credit union which offers credit cards and extends credit limits to card holders who qualify. Now, always remember that a credit card refers to a card in which you have the overdraft facility, okay? Whereas a debit card is a card in which there is no overdraft facility. If your balance is zero, you cannot withdraw anymore. However, in case of credit cards, even if you have a zero balance, you can still withdraw, and they'll adjust it with the future income on the account. So, when consumers make credit card purchases, the credit card issuer is responsible for sending the payments to merchants for purchases made with credit cards from that particular bank. So the moment the moment the credit card holder makes any purchases, it becomes the duty of the bank to send the payments as due. Okay, it will go out of the account of the individual. At the same time, if the account doesn't have the enough funds, then it'll be the duty of the bank, or it'll be the duty of the credit card issuer to provide with the remaining finance. And additionally, a credit card issuer is basically a type of lender. Because as I've said earlier, in case of credit cards, if you don't have money also, you can still take out money. So the issuer becomes a type of lender. So card issuers accept a certain amount of risk when they approve credit card applicant. In fact, many Indian and foreign banks have become credit card issuer companies in order to help the customers. So the issuing bank, it often ties up with a number of establishments, which includes hotels, hospitals, shops, petrol pumps, and departmental stores which honor credit cards. So it depends upon the store whether or not they have linked up, or whether or not they have tied up with the banks or the credit card issuer companies. If they have not, then you cannot use a credit card in those specific shops. Okay, only when they have come up with an agreement, only then can you use your credit card in those shops, as have been mentioned in the it depends upon the agreement between the shop and the credit card issuer company. All right. So the issuing bank often will provide a facility of credit cards only to a selected number of customers, depending upon their monthly income, their credit worthiness, or maybe they can even issue credit cards to company executives, businessmen, and maybe even high and middle income individuals. Okay, so the credit card issuer will accept a certain amount of risk when they approve credit card applicants, and they'll extend the credit limit as well. And as we've said earlier, because this is based upon the credit worthiness, based upon the trust, right? So they will issue the shares only, they will only issue the shares to those people whom they feel are trustworthy enough, and because there is a certain amount of risk attached to credit card issuing. So basically, the use of credit cards will help the holders to take advantage of two essential aspects of financial service functions. Firstly, transmission of payments, and secondly, granting of credit. And the development of credit card has facilitated the use of both of these functions together, okay? Transmission of payments and also granting of credit. As we've seen earlier also, when we were talking about the different functions of your financial services and your financial institutions, mainly it is for transferring of money from those sectors that have it to those sectors who do not need it, and to those sectors who have it, okay? So transmission of payments and also borrowing loans also, so granting of credit also. So both of these functions can be achieved with the development of the credit card. So credit cards have been rightly called plastic money, and the main objective of issuing of credit cards is to provide convenience and security as a whole. So it eliminates the cumbersome cash transactions, just like in case of debit card also. It eliminates the need for carrying cash with you, okay, and it protects the possible danger of pickpocketing of a lot of cash. So in case of credit cards, there is usually an interest-free credit for 30 to 45 days. And you can to your credit card, you can charge your groceries, hotel bills, and then telephone bills, taxes also. All these can be paid through your credit cards. So these credit cards, these plastic money, will have the photo identity and the holder's signature embossed on the card. So just like, it's basically the same, just like your debit cards, okay? So they will have the name as well as the the signature of the holder of the card, and it also has the issuing bank's name and validity period of the card. And the bank issuing the credit card will be knows that the customer has the sufficient credit worthiness, and only based on that will they provide them with the credit cards. Now, the number of credit card holders and the participating business establishments, hotels, etc. have increased enormously over the years, and it has run into a couple of millions these days. So some Indian banks, like you have your Andhra Bank, Canara Bank, these have all entered into agreements with some international banks and agencies to have even internationally acceptable credit cards, not just to be domestic cards, but also international credit cards, which are particularly useful to your businessmen and then your export traders and foreign trade agencies who tend to travel quite a bit. So the existence of, in fact, more sophisticated computers with large capacity memory has provided the momentum for the development of credit cards as well. And in fact, nowadays, credit cards are increasingly replacing cash and check transactions. Okay, people tend to use plastic money more often than actual money. And as a result of that, the number of credit card issuer companies have increased quite rapidly. Okay, so that is about credit card issuer companies. Now, let us look a little into the problems that are faced by the financial services sector in India, which are also known as the constraints of the financial services sector in India. So firstly, the first problem that is faced is lack of education among investors. Now, everybody talks about investing. I have money, I want to invest here, I want to invest there. Even when you turn on the TV, when you see advertisements, they're all about investments, right? People will tell you, invest your money here, invest your money in mutual funds, invest your money in certain stocks. But everybody's telling you where to do it, but they're not telling you why to do it or how to do it, right? So there is a lack of education among the investors. And with the regards of more and more products are being introduced these days. Introduction of financial products, new financial products are there. All of this will be useless if the investor is unaware of the advantages and the uses of the product. So they have been telling you on television you should invest in mutual funds, but why should you invest in mutual funds? Okay, even though they tell you in brief, they don't tell you in detail, right? So it becomes useless. All these new products, new concepts that are being introduced become useless when the end user of these products or the end user of the information doesn't know why they're investing in those situations. Therefore, the financial intermediary should firstly educate the prospective investor about the usage and advantages of the new product or of the innovative product. Okay, and then next you have lack of standardization. So financial service institutions have to offer a wide range of services, so it is very seldom that the financial services can be standardized. They are unable to create standards and they're unable to meet those standards. Why? Because they're keeping on changing the products that they're offering. Okay, today they're offering one product, tomorrow they have opened up with a new product, and as a result of that, because they're constantly changing the types of products that they're having, it is difficult to create a standard and to meet the standard. So there is lack of standardization. And thirdly, inadequate and poor quality information to the users. So the end users of the information and the end users of the financial products are either provided with inadequate or with poor quality information. And sometimes, even though they are provided with enough information, the information may be filled with business jargons, they may be filled with complicated terms and words that they cannot understand. Okay, so there is poor quality information that is provided. Therefore, it's said that it's high time that the sector, the financial service sector, they opt for better levels of transparency, that they try to disclose the requirements, that they try to disclose all the information that is available with regards to the financial service instruments to the end users of those information. Moreover, the disclosure requirements should be also in accordance with international standards so as to ensure transparency. And next you have lack of research. So lack of research is one of the main problems faced by financial service sector in the country because most of our financial intermediaries, they do not take up research activities seriously. They do not try to analyze, they do not try to figure out what exactly is required by the public or by the general, by the end users. So they do not know the needs and the wants of their customers as such. So proper database needs to be maintained and recent data should be taken into consideration so as to help make sound financial decisions. And finally, you have high service cost. The financial service sector is highly labor intensive, which raises the cost of financial products and services. Okay, because there are the financial service sector considers a lot of labor. They need a lot of human resources, right? Just like how we saw in case of your mutual funds also. They have agents, and these agents, they have to travel far and wide in order to find people or to find investors for these mutual funds, right? So they require a lot of labor. They have high labor intensive programs. Okay, so as a result of that, the cost of labor increases. Therefore, the cost of financial products and services also increases. Okay, so these are the problems which are faced by the financial services sector in the country. Now, additionally, you can just go through the list of some top financial companies in India, wherein you have SBI, Capital Markets, and then after that you have the Bajaj Capital Limited, and then you have Birla Global Finance Limited, and then HDFC, and then Punjab National Bank Housing Finance Limited, and then you can also study into the ICICI Group, and then LIC Limited also. Okay, these are the top financial companies in India at present. And when it comes to India, the financial service sector in India, we are dealing mainly with the insurance sector, with the banking services, with the mutual funds industry, and also we have a certain financial service sector which deals with the mergers and acquisitions in India as well. Okay, so these are the main categories of financial service in India. And with that, we have come to the end of the first unit.